Hello everyone, I hope so you will be fine. So today we are going to discuss the practice question and our topic is statement of financial position. Statement of financial position is also called balance sheet. So here we go, we have a first question. Question number 1 is when a non-current debt should be included in the current section of statement of financial position if. In simple words, so there are two types of question can be asked. Question number 1, when a non-current liability can be recorded as a current liability. If this is the question, so the answer would be the definition of current liability. Simply you have to select where is the definition of current liability is written. Another question could be where a current liability can be recorded as a non-current liability. If this is the question, so this question is relevant to refinancing of current liability on non-current basis. So this I'll explain in the second question. So first we are discussing this first question. So it means where we have to identify where is the definition of current liability. As we know, the current liability is the liability which will be settled within 1 year from the reporting period. This is the normal definition. But in the gap we say any liability which will be settled within 1 year from the reporting period or operating cycle, whichever is longer, right? This is the definition. So here we have to look where is the option for current liability is available. So we got four options here. Option A, a management plans to refinance it within the year. Actually this option is for a refinancing option. Another question, but this is not the definition of current liability, so this is not the answer. Option B, if it matures within the year and will be retired through the use of current asset. Actually this is the definition of current liability, because we say the current liability is the liability which will be settled within 1 year, okay, or operating cycle whichever is longer. And obviously we use always current assets. Maybe we can use cash to pay current liability, or maybe we can use other current assets. Sometimes current liabilities can be settled by creating another current liability. For example, maybe I have taken a loan to repay the existing liability. Now option C, it is to be converted into the common stock. No, it is not the option. Then we have option D, a bond retirement fund has been set up for its scheduled retirement during the next year. Actually guys, this is the definition of sinking fund. So what is the concept of sinking fund? It's not a liability. Sinking fund, sometimes we take a loan and maybe we can create a fund, a reserve, and every year we can keep some money into that fund, and that fund we can use to retire that loan in the future. So this is actually the definition of sinking fund. It is not the definition of current liability. So option B is correct. That is the definition of current liability. Understood guys? Now we are moving to question number 2. So question number 2, first I'm reading requirement. How should the debt be classified on December year 2 balance sheet of the company? That how you can record this liability in the balance sheet. For example, we are preparing our balance sheet on December year 2. This is our reporting date. And here we have a debt at this date, and they are asking how this debt should be treated. So now let's go through the date of the question. A company has 100 million of debt that is due in March year 3. So our year end is 31st December year 2, right? So liability is going to settle in March year 3. It means it is going to settle just in 3 months. So it is going to be your current liability. Then next part of the question, in December year 2 the company entered into a non-cancelable agreement with its lender to refinance the debt with the same interest rate and the full principal is due in December year 5. Now what happened here, guys? So we have our liability which was current liability at our reporting date, right? This current liability is going to refinance on non-current basis. Like for example, I'm just giving example, let's assume I have taken a loan and that was due in just 3 months, but I am going to enter into another contract and I'm going to refinance this liability on non-current basis. So if this is the scenario, now the question is, should we record this liability as a current liability or as a non-current liability? So we have to check here 2 points. Point number 1, so whenever there is a refinancing option is there, so you have to check 2 points. If a company has intention on December year 2 or at the reporting date, not only at the reporting date, we can also refinance this up to the date when financial statements are authorized to issue. I'm assuming 1st April is the date when financial statements are authorized to issue. From reporting date until the date when financial statements are authorized to issue, if 2 points are there, so then we don't need to show this liability as a current liability. We can show this liability as a non-current liability if it is refinanced on non-current basis. So now which 2 points are there? Point number 1, if a company has intention to refinance this liability on the basis of non-current basis. First point is company has intention at reporting date or up to the date when financial statements are authorized to issue. Second thing, the company has demonstrated that intention to refinance, and how it can be demonstrated? By entering into the agreement, and company has entered into the agreement, right? Non-cancelable agreement. If these 2 conditions are met, then that current liability can be shown as non-current liability. It means we need not to show that liability is the current, so we can show as a non-current liability. So it means, what is the option? So this liability should be classified as long-term liability, okay, because it is going to refinance on non-current basis. So why other options are incorrect? So first option is that this should be classified as a contingent liability. No, it's not a conditional. Option C, it should be classified as current liability. No. So it should be considered as off balance sheet liability. Option D, no. So it is not off balance sheet, we have to record on the balance sheet. Understood? So option B was the correct answer. Now we have another question. A long-term obligation that or will become callable by creditor because of the debtor's violation of the provision of the debt agreement at the balance sheet date should be classified as. Let me tell you a story, guys. For example, I have taken a loan, and maybe if this loan, maybe you can assume it was non-current loan, okay, non-current liability. But if I will violate any condition, please note, if debtor will violate any condition or covenant, this loan will become callable and this loan will become current liability of the debtor unless it is waived by the creditors. What it means? So for example, if I will violate the condition, I would pay the whole amount immediately and it will become my current liability. But if the relaxation is given by creditor side, lender side, so maybe if the lender will ask me, no need to pay immediately, I can pay on routine basis, so then it is another matter. So here we go. That's why look at the option D, current liabilities. This should be recorded as current liability until the creditor has waived the right to demand payment for more than 1 year from the balance sheet date. Understood? This is the option because it is your current liability. So it's not a long-term liability. No. Option A is not the long-term liability. So option B, it's a current liability unless debtor goes bankrupt. No, it's not necessary until debtor goes bankrupt. No. Option C, conditional liability unless violation is corrected. No, it is not the conditional. Okay, it is your current liability unless the option is waived by the right. So we have a next question now. A company received an invoice in January for the electricity used by its warehouse in December, and actually we have expense relevant to the December, okay, but it is being recorded in the month of January. Now if you will look here, this expense should have been recorded in the month of December, right? Because this expense belongs to the month of December. Okay, so in December the entry should be debit. The entry should have been debit expense and credit liability, because it is not yet paid by the end of December. Okay, but in actuality they have recorded in January, so they have recorded debit expense, credit, cash or payable, because there is no information this expense has been paid in the January or not, but they're saying it is recorded. So it means if you will look, so this expense should have been recorded in December but is recorded in January. So what is the impact of this error? So this is what is the question. So what is the impact into the company's financial statements? So if you will look in December, so expenses are not recorded, it means your expenses are understated. If expenses are understated, so then profit or retained earning is overstated. Why? Profit means a net income. If expenses are understated, net income will be overstated, and same net income is transferred to the retained earning in equity section. It means retained earning is also overstated, right? On the other hand, liability is understated because you have not recorded this liability in December, right? So now here we go, we have to read the option which is the correct option. If you will look into the option C, current liabilities were understated and retained earnings were overstated. Yes, it's correct. Option A, accrued expenses were overstated. No, expenses are not overstated, expenses are understated. Option B, operating expenses were overstated. No, expenses are understated, right? So C is the correct option. Then D option, cash and cash equivalents were overstated and retained earning were understated. No, retained earning is overstated, right? So it means C option is the correct. Now we have a next question. The question is, in the corporation's December 31st year 6 balance sheet, the total asset should be reported at. They're asking about assets, okay? Like what should be the value of asset? Now let's read the question. A corporation was incorporated on January 1 year 6. It's the start of year. With 500,000 from the issuance of stock. So this is the value of equity at the beginning of year. And borrowed funds of 75,000 during the first year of operation. Actually it is the amount of liability at the beginning of year. Net income was 25,000. On December 15, the corporation paid 2,000 cash dividend. No additional activities affected the equity in year 6. At December 31st, year 6, the corporation's liability had increased to 94,000. So this is the value of closing liability, and they're asking about what is the value of asset. So we know accounting equation, assets are always equal to liability plus equity. So liabilities are given at the end of year 94,000. You can check in the question, because we need liabilities at the end of year, not at the beginning of year, because we prepare balance sheet at the end of year. And for equity, so we are provided the beginning value of equity, net income and cash dividend. So you know the equation of capital, opening capital plus net income for the year or minus net loss for the year minus dividend equals closing amount of capital, right, or equity. So here we go, we have opening capital 500,000 given in the question, plus we have a net income of 25,000 given in the question, minus we have a dividend of 2,000 given in the question. So closing capital is 523,000. So it means equity value is 523,000. So liability plus equity is going to be the value of asset, which is going to be 617,000. Understood? So it means asset value is 617,000. So option A is correct option. I hope so guys it is clear. Thank you so much. See you in the next video.